Thank you.
Hello, welcome, and thank you for joining us today for our webinar, Current Insights on the Clean Energy Transition and Investment Opportunities. My name is Marianne McChesney, and I am a member of the Boston University Alumni Relations staff. Today's webinar is sponsored by the Boston University Alumni Association and is offered to our 339,000 alumni around the globe. Before we begin, I'd like to welcome the many members of our BU community who are joining us today from all over the world, from places as far-reaching as Denmark, Turkey, Australia, and Vietnam, to Washington, California, and Texas. Wisconsin and Illinois represent the Midwest, and spots like North Carolina, Virginia, Pennsylvania, and Florida are tuning in, along with those from Maine, New York, New Jersey, and Massachusetts. Alumni and friends from 8 countries and 20 or more states are interested in today's topic, and we're so glad to welcome you all here today. For a few housekeeping notes, today's presentation is being recorded and will soon be available for on-demand viewing on the Alumni Association website, and we'll send you a link after the program has ended. Also, our panelists are looking forward to answering your questions. You are welcome to submit them throughout the presentation using the Q&A box, and you can find this box by hovering over your screen, locating the Zoom toolbar, and selecting Q&A. These will be answered at the end of the program, but you can submit them at any time. Now it is my great pleasure to introduce our featured speakers. Dr. Cutler Cleveland is a professor of Earth and Environment and Associate Director of the Institute for Sustainable Energy at Boston University. The Boston University Institute for Sustainable Energy is a university-wide center dedicated to accelerating the transition to a sustainable, climate-safe global energy system. Through interdisciplinary research, policy analysis, and collaborative engagement, the mission of the ISE is to ensure that the energy systems of the world provide abundant, sustainable, and universally accessible energy services to both emerging and advanced economies. In brief, Dr. Cleveland's research and teaching focus on the connection among energy, climate change, and sustainability. And he recently served as the principal investigator for Carbon Free Boston, a technical assessment of strategies to assist the city of Boston in reaching carbon neutrality by 2015. Jennifer Leonard is a 1994 Boston University graduate of the College of Arts and Sciences, where she studied economics and went on to earn degrees in finance and international studies at UPenn. She is a CFA, an executive director of asset manager due diligence, and portfolio co-manager at Cornerstone Capital Group. In a career spanning microfinance, institutional financial services, and impact investing, Jennifer has developed a unique skill set in working to deploy capital for social and financial returns. Before arriving at Cornerstone Capital, she was vice president of impact investing at the Caprock Group, where she co-led the firm's impact practice and helped clients build customized, impact-mandated portfolios. And prior to that, Jennifer was a Latin America equity research analyst at Morgan Stanley, following the telecommunications, media, and technology sectors. Thank you, Cutler and Jennifer, for being here today. It is my great pleasure now to turn the presentation and discussion over to Dr. Cutler Cleveland. Cutler, the floor is all yours.
Great. Thanks, Marianne. Thanks for the introduction. And thanks for the opportunity to connect with some of our alumni and friends and to share this virtual podium with Jennifer, a distinguished alum from my home base, the College of Arts and Sciences. Prior to the COVID-19 pandemic, the deployment of clean energy, such as solar and wind, was accelerating, spurred in large part by concern over the effects of climate change, such as sea level rise, flooding, wildfires, and extreme heat events. But like every other aspect of our existence, the pandemic has altered how we think about clean energy and climate change. The pandemic has dramatically transformed the economy, our health, our social lives, and our emotions. It has also laid bare stark differences in people's perception of the role of government, the usefulness of science, and America's place in the world order. The pandemic continues to take a very large human toll, but it has also produced behavioral changes and revealed new opportunities to address climate change and other sustainability challenges. So this is what Jennifer and I are going to be talking about today. So let's start with a general framing of climate change from a global perspective. Global emissions of greenhouse gases from fossil fuels, shown here on the vertical axis, have doubled since 1970. This is for the world as a whole. Those emissions are the principal cause of the observed 1 degree centigrade increase in global temperature above pre-industrial levels. Climate scientists are in strong agreement that the worst impacts of climate change can be avoided if we keep global warming below 1.5 degrees centigrade. However, we will reach the 1.5 degree threshold between 2030 and about 2050 if temperatures continue to rise at the current rate. Emissions must be halved in the next decade and be driven close to zero by 2050 in order to stay in the neighborhood of the 1.5 degree threshold. Just looking at that graph indicates that anything remotely resembling business as usual in our energy system will not get the job done. Is a rapid and nearly complete transition away from fossil fuels possible? How much would it cost? These are some of the paramount questions that we face. At a high level, here's how we do it. A carbon neutral society minimizes the demand for energy. Every building is a high performance building. Travel shifts from single occupancy vehicles to public transit, biking, walking, and shared modes. Waste diversion is maximized. A carbon neutral society converts systems that currently run on fossil fuels, such as cars, furnaces, and stovetops, to use electricity instead. Heating systems are converted to heat pumps and electric boilers wherever feasible. Light duty and medium duty vehicles are powered by electric motors, otherwise known as EVs. A carbon neutral society uses electricity that is close to 100% free of GHGs, greenhouse gases, such as wind, solar, and possibly nuclear power. Sustainably sourced renewable fuels are used in highly efficient district energy systems, emergency backup systems like for hospitals, and heavy duty vehicles. The essential role of equity in sustainability is being demonstrated every night on the streets of America. The social argument, the social justice argument for equity in climate change contends that each person's contribution to society is valuable and that we must address barriers and historical factors that have led to unfair conditions for marginalized populations. There are also a host of pragmatic reasons to reduce inequity. Higher incomes directly reduce poverty that takes an enormous economic toll on society. Equity enhancing policies, such as investing in education, can boost economic growth, which in turn, under the right conditions, can alleviate poverty. Equity also enhances social cohesion and reduces political conflict. So, what is the nature of major energy transitions and what causes them? We can begin to answer those questions by examining earlier energy transitions. So I'm going to spend a few minutes talking about this chart, which indicates what sources of energy have been used to generate electricity in the United States since 1920, which is the first year in which we have reliable data. So the vertical axis shows what fraction of total electricity generation comes from various sources. And examining this chart is informative because the trends underlying the data series that you see provide insight to the technological, political, social, financial, and environmental forces that shape energy transitions. So I'm going to use my little laser pointer here. And let's start by looking at the beginning of the series. Up here in the blue line is the fraction generated by coal, and this red line is a fraction generated by hydropower. So coal and hydro dominate in the early 20th century due to their physical abundance. We have a lot of big rivers that can be dammed, and we have substantial coal resources. And they were also low cost. But as the demand for electricity grows over the next few decades, the share of hydropower declines as most of the large river systems, particularly in the West, are developed. But note that it takes about 40 years for hydropower to lose just half its share of total electricity generation. A rather remarkable observation is that coal remains a dominant source of electricity generation for nearly a century. It was really the workhorse behind much of the economic development of the US economy in the 20th century, and then begins to drop sharply in the last 10 or 15 years. I'll come back to that in a moment. Oil and gas, which are down here in green for gas and purple for oil, take increasing market share after World War II due to major new discoveries and new pipeline infrastructure. But again, it takes decades for those sources to capture significant market shares. Now let's examine nuclear power, which is this light blue line shown here. The first power plant comes online in 1957 in Shippingsport, Pennsylvania, but it takes more than 2 decades until nuclear power captures just a 10% market share of power generation. A key lesson here is that major transitions, at least to date, take a long time. And by long, I mean multi-decadal scales. This is especially true for capital-intensive industries that develop widespread end uses and that cultivate powerful political constituencies. This is certainly the case for coal and the other fossil fuels, and nuclear power for that matter. Compare these timescales to my first slide that illustrated a need to go from 50 gigatons of greenhouse gases to 0 in 30 years. Achieving a carbon neutral energy system will require changes in both scale and time that are unprecedented in our history, and indeed unprecedented in human history if you study energy transitions in other countries. The effects of public policy are also evident in some of these trends. Let's focus on the year 1978. In the wake of the oil price shock caused by the Arab oil embargo in 1973, the Fuel Use Act of 1978 forcibly discouraged the use of oil and gas to generate electricity and encouraged and heavily subsidized the use of coal in power generation. The result? Look at coal's market share jump dramatically in a very short period of time, and both gas here in green and oil in purple drop dramatically. So that is the direct result of a decision made by Congress. Now let's turn to solar and wind. Down here in the bottom right corner that you can see where my laser pointer is. Tax credits, state renewable performance standards, or portfolio standards, I should say, and state greenhouse gas emission targets and other policies have helped boost solar and wind in the last decade or so. They're really taking off. And in Europe, subsidies such as feed-in tariffs have helped drive the fastest expansion of renewable power in the world. Wind and solar are also a good example of another important driver of transitions, technological change that alters the relative cost of energy. Here's an example for the cost of photovoltaic energy in the US. So this is the term given to the solar panels that you see on people's roofs and the large fields of solar arrays that generate power. And the vertical axis shows the dollar per watt of new installed power. And the point of this is this precipitous decline in the cost of PV, largely due to technological improvements such as higher solar cell efficiency, lower equipment costs such as inverters, and lower permitting and interconnection costs. So solar, a similar trend is observed for wind. And we're also seeing a somewhat similar trend, although it started later, for battery storage. So that certainly has helped boost this increase in solar and wind. What's good for the goose is also good for the gander. There's a lot of technical innovation that's happened in the fossil fuel industry that has also affected these trends. A good example of this is hydraulic fracturing and horizontal drilling, which collectively are known as fracking. And fracking has made previously uneconomic deposits of gas readily available at low cost, and gas has come online at a very rapid rate. You can see this big uptick in gas, which is due in large part to fracking. Nuclear power has also experienced a lot of innovation. A process known as uprating, which increases the electricity that one plant can produce, has been caused by more highly enriched fuel, greater heat output, and more advanced turbines. As a result, nuclear power has maintained a roughly 20% share of the market for a long time, even as very few new power plants are being built. There's actually fewer plants operating today than there were 20 years ago. Social norms also play an important role in energy transitions. Clearly, part of the uptick in wind and solar and the decline in coal is a concern about climate change and reducing emissions. Nuclear power faces an uncertain future because of opposition in some quarters to constructing new nuclear power plants. Fracking, as most of you know, is very controversial, and it has actually been banned in a few states and is probably facing increasing regulation. And equity has also grown increasingly important. The impacts of air pollution, for example, caused in many parts of the world from coal combustion, the location of pipelines and other infrastructure, all tend to fall disproportionately on socially vulnerable populations. So that gives you a little taste of important energy transitions in the US and what has driven them. So one question that I always ask my class when I talk about these trends is, if you extended that time frame out 20, 30, 40, 50 years, what would those lines look like and why? So the pandemic, of course, has impacted all of these forces. One of the most important ones, which Jennifer is going to talk about in a moment, has to do with energy market fundamentals. How have the fundamental economic and financial forces been changed? Where we left off before the pandemic, in case of power generation, is this fundamental economic calculus. This is what's known as the levelized cost of new generation capacity in the US. So what this refers to is, if you were going to go out and build a wind farm or a natural gas power plant or a new nuclear power plant, what would it cost to build, operate, and maintain that facility over the lifetime of the facility? So it gives you what's called a levelized, or sort of an average cost over the lifetime of the resource. And some of the key takeaways here are that onshore wind and solar are as cheap as natural gas. So wind and solar without any subsidies are currently competitive with natural gas. And in many parts of the country, onshore wind is actually much cheaper than natural gas. Offshore wind is more expensive than onshore, but its costs are also falling. Coal and nuclear power have much higher levelized costs. And those costs for coal, in addition to environmental concerns, particularly climate change, has essentially sealed the fate of coal in this country in terms of declining importance. And the high cost of nuclear is one of the reasons why we don't see a lot of new investment flowing to nuclear power. The pandemic has also produced some changes that are relevant for climate and sustainability, some that we'd like to hang on to, and others that we would like to lose or reverse. We've seen a greater appreciation for open space, particularly in cities. In cities, we've also seen an appreciation for and access to safer, quieter public streets. Big drop in air pollution around the world, which people have noted. We've seen in cities especially a big uptick in active transportation. You can't buy a bike in New York, I'm told, due to the increase in demand for bike. An increase in telecommuting, which reduces greenhouse gas emissions. And there's been a large reduction in air travel for both personal and professional. But there are also some things that have happened due to the pandemic, which we would like to reverse from a climate perspective. A big one in cities is the demand for public transport. How do we get people back on buses and subways? This is a huge challenge for cities. There's also a misperception that population density is the enemy in terms of the pandemic, which it is not if you actually look at the data. And we've also seen employers incentivizing single occupancy combustion vehicles for people to return to work. People's attitudes towards climate change will be important. The most recent polls, which came out a couple of weeks ago, do indicate that most Americans still view climate change as a very serious problem. So that concern seems to have survived or have perhaps even been reinforced by the pandemic. And then again, social equity is extremely important. There are many opportunities to simultaneously improve public health, reduce emissions, create new jobs, all the while improving social equity. So with that, I will now turn things over to Jennifer, who will take us into a deeper exploration of the area of investment in clean energy and ESG investing. Jennifer, take it away.
Thank you, Cutler, and good afternoon, everyone. I wanted to start our discussion today on renewable energy and infrastructure as an investment opportunity by outlining where we've been, where we are currently, and where the market is going. So just to give you a sense of historically, over the past decade, more than $2.7 trillion has been invested in renewable energy capacity. Over that period, renewables more than doubled their share of the global power mix from 5.9% in 2009 up to 13.4% last year. At present, the global renewable energy market is estimated to be about $928 billion, and it's estimated to grow to more than $1.5 trillion by 2025. So the compound adjusted growth rate on renewable energy market is about 6.1% per year. So we're seeing significant growth in this market, and it's an interesting opportunity. And Cutler laid out some of the reasons for that, but just to recap, we've seen an increased focus on greenhouse gases and cost of fossil fuels. We've seen higher volatility in traditional fossil fuel pricing and falling production costs for renewables, which has been a huge driver. And then we've seen continued technological advancement and increasing government support for renewable energy through both stricter regulations related to climate change, but also in certain instances, subsidies or tax breaks related to renewable investments. So all of those factors are combining to really create an interesting opportunity in the renewable energy markets right now. In terms of talking about what technologies people are investing in, there's really 5 that I wanted to highlight today, and those are hydroelectric, wind, bioenergy, solar, and geothermal energy. The most advanced of these is hydropower. It's the most advanced, efficient, and cost-effective renewable power generation technology at the moment. The Asia Pacific region accounts for the largest share of global installed hydropower, with China alone accounting for 25% of the global hydropower capacity. The other market I wanted to talk about today is solar, because solar is the market that we're seeing grow the fastest. Cutler outlined how the cost of solar has declined over the past several years, and that is really a driver behind it. But 10 years ago, just to give you a sense, there was 4 times as much installed wind capacity as solar. But last year overall, around the world, solar passed wind. So this is true across all areas of solar investing. We're seeing it in utility scale solar, commercial solar, and in residential solar, just this boom in growth. Over the past 10 years, the world's electricity system added more solar power generation capacity than any other form of energy production. And in 2018, the global solar market was estimated to be 52.2 billion, but it's estimated to grow to 223 billion by 2026. So that's a significant growth. It's a compound adjusted growth rate of 20.5% per year. So we're expecting solar to continue its growth trajectory. Looking at where investors are committing capital geographically to renewable energy investment, it's interesting because the markets that are attracting the most investment right now are developing countries. And namely, there's two markets that are leading the charge overall, and that's China and India. So in China, renewable energy accounted for 38.3% of the total installed power capacity. It's mostly hydropower and wind, but solar is close behind and it's growing more quickly. In India, 21.3% of the total installed power capacity is renewable, but this is forecast to rise to 55% by 2030. In India, solar and wind are the leading types of renewable energy, and more than 42 billion has been invested in India's renewable energy sector since 2014. In 2018 alone, new investments in clean energy in India reached 11.1 billion. So we're seeing significant growth continue in these two markets. By contrast, the renewables market in the US accounted for more than 17% of net electricity generation, with the bulk coming from hydropower and wind power. But again, solar is the fastest growing, and by 2050, it's projected to account for 48% of the total US renewable power generation. So if you look at the developing markets versus the developed markets in terms of market size and what we're seeing in investment, you'll notice that the developing markets had about 200 billion of investment in 2017, and then that's leveled off in the subsequent years to 150 billion in each year, whereas developed countries have been at about 135 billion per year. So it's not a huge difference, but developing markets are leading developed markets in renewable investment, which is very interesting. There's also a number of other investments that can combat climate change in addition to renewable energy power generation. And the two biggest markets here that we're seeing investor interest in is, first of all, the energy efficiency space, which includes such areas as battery storage and electric vehicles. Both of these areas are growing very quickly, and we're seeing a lot of investor interest there. And also in water and wastewater treatment and reuse. So this encompasses areas like wastewater utilities, where you're seeing repurposing and reuse of water, desalination plants that are converting salt water to clean water, and smart water metering, where you're seeing water technology companies better deliver water in municipalities to increase efficiency and reduce waste. So those are some of the other areas we're seeing growth in the current market environment. In terms of the shape that investments can take, there's really two structures you can look at for renewable energy, and that's the private market and the public market. And I'll start with public markets, which, public equities and public fixed income. These markets saw a 6% year-over-year increase of funds flowing into the renewable energy investment space in 2018, with solar accounting for about half the total. So that's up about 8% year over year. Over the same time, we saw investment in wind decline by a third. So again, you're seeing this bifurcation between high focus on solar and a reduced focus on wind. Within the public equity markets, let's start there. There's really two ways that you can invest in renewable energy or energy efficiency companies. And the first is, by buying individual stocks in renewable energy enterprises. The second is, and this is, I think, very exciting for the markets, there's a number of investment funds that are thematically focused around renewables and energy efficiency investments. And I like these because they offer better diversification than investing in an individual stock investment, and they come in different formats that can suit different investors' needs in terms of sizing and liquidity. So these funds, the thematic funds, are we're seeing more and more come out all the time, and it's definitely a growing area within the public equity space. And I think it's nice because it offers investors the opportunity to have both liquidity and reduced risk while investing with a clean energy mindset. Looking at the fixed income side, we again have individual bonds in renewable and energy efficiency companies that you could buy, or you could buy municipal bonds that are backing renewable power projects. Or there are thematic funds as well, similar to what I was talking about in the equity markets. There's fewer of these in the fixed income space, but there are still, they do exist, and that is a growth area. But the area that I'm most excited about within fixed income is the green bond space. And so green bonds are bonds where the use of proceeds finances energy efficiency projects or renewable energy projects at traditional corporations and municipalities. So the way that it works, instead of having your universe limited to a renewable energy producer or distributor, you can buy a bond issued by a traditional corporation like a telecom that is looking to green retrofit their facilities, or you can buy an issuance from a tech company that is looking to convert to solar. And these securities can be issued by any type of corporation or federal, state, or local government, as well as by supranational organizations like the World Bank. So issuance, we saw hit a new record in 2019 of $252 billion. That's up 51% year over year, with the European market accounting for 45% of the total issuance. So Europe does tend to lead the market there, although the US is doing more issuances, as we're seeing more and more in emerging markets as well. So that's been very exciting. Looking at the private market side, private markets tend to take the shape of one or two asset classes. So the first asset class that you can invest into renewable energy or energy efficiency through is real assets, which is hard assets that you can, like real estate or solar projects that you can actually touch the physical asset. Renewable energy infrastructure funds are the primary way of investing into the renewable energy market here, and that would be where an investor invests in a portfolio of solar, for example, solar projects. And they're interesting because different funds invest at different points of the capital stack. So you could do an equity investment or a debt investment, depending on the fund, and also different points of the project life cycle. So some funds focus on very secure cash flows that occur after the power purchasing agreements are signed. Or you could take on more risk and try to earn a higher return by investing at an earlier stage, like the construction phase of a project. There's also sustainable real estate funds within real assets, which tend to be green retrofit funds, where investors are buying a portfolio of buildings, refurbishing them and green retrofitting them with such items as LED lighting or low flow toilets, and then eventually looking to sell the portfolio of buildings for a profit. Looking at the venture capital, private equity, or direct investment space, that's the other space we're seeing a lot of early or later stage private companies involved in energy efficiency, the clean energy supply chain, or renewable energy production and delivery. That's been a growth area, and we saw investments in renewable energy rise 32% in 2018, but this is off significantly from the peak that had occurred in 2008. Most investment made here was made into more mature private equity stage investments. We've seen less investment in early and late stage venture capital. That fell in 2018, but half of the venture capital and private equity investments, it was interesting to note, went to solar, with just 1/10 going to wind. So again, you're seeing that market dynamic of solar versus wind play out. The private markets also offer interesting investment opportunities for combating climate change in other forms. And this, within real assets, for example, one can invest in sustainable timber strategies that more sustainably harvest timber for an increased forest health, decreased risk of wildfires, and an increased ability to process greenhouse gases. From private equity funds and direct investments, you see a lot of investments that are focused on nexus issues with climate change and clean energy. So for example, clean cook stove investments. You're seeing investments that benefit certain social strata, such as we're seeing investments in women in terms of investing in women in emerging markets where women are disproportionately impacted by a lack of clean energy access and climate change, because women are the ones that are cooking using charcoal instead of clean cook stoves. They're the ones that are having to walk miles to get access to clean water. And so by investing in climate change, you can have the secondary benefit of benefiting women in emerging markets as well. Another group that you can invest in to combat climate change in another form is investing in farmers and agriculture. So climate change has had a dramatic impact on crop cycles in both developed and emerging markets, and combating climate change is crucial to future food security. So there are investments out there where you can invest to benefit agriculture producers, and this can also benefit climate change as well. So there's some interesting opportunities there. I wanted to touch on the COVID-19 pandemic and the changes that have happened in renewable investing as a result. And it's been interesting because in one sense, we've seen luckily no change in demand for renewable or energy efficiency investments overall. We continue to see increased demand for sustainability strategies overall and investments combating climate change in particular, especially renewable energy. Climate change does continue to be a key focus for clients, and that's been really heartening to see during the pandemic. However, we are seeing an increased focus on liquidity and a decreased tolerance for risk over the past couple of months. And given that we're in a risk-off environment and the focus of liquidity has caused some to steer clear of private market investments because of the longer lockup profile. So typically, private investments such as real assets, venture capital, or private equity have at least or have around a 10-year lockup, and direct investments offer no foreseeable exit strategy when you buy into them. So the lack of liquidity in those formats of investments has put more liquid public market investments at the forefront, and we're seeing more money flowing into liquid public markets as opposed to the more illiquid markets. The oil market has also had a role in the renewable energy demand. The markets for oil suffered significant price declines due to a mix of decreased demand from the pandemic and a price war between Saudi Arabia and Russia earlier this year. So recent volatility in the oil markets, on one hand, benefit renewables because pricing for renewables had been more stable. But this stability was also offset by significant oil price declines, which made traditional energy more attractive from a cost perspective. But this trend has started to reverse. So it's something to watch going forward, but traditional energy pricing continues to play a role in demand for renewables. We think the volatility that you've seen in the market over the past couple of months is likely to continue until the virus abates or a medical solution such as a vaccine is developed. So unfortunately, I think we're in for some more volatility in the short term. I wanted to mention emerging markets as well for a minute, just because emerging markets have been hit on multiple fronts with the pandemic. They've got, in addition to the humanitarian crisis, they're seeing declines in commodity prices, which are oftentimes a primary export. They're seeing a pullback in tourism, which is another primary revenue driver, decreased remittances from abroad, and they're seeing capital flight as well. So in the short term, even though I know earlier I said developing markets are leading the charge on investments, I think over the long term, this trend for renewable energy and energy efficiency will be the same. I think it's going to maintain. But I do think that in the short term, emerging markets could see investment outflows. But again, I think this is a short-term trend. I think longer term, the uptake for renewable demand, just based on what we're seeing, especially out of India and China, is going to remain. That is all I had. So I will turn it back over to Cutler, and we can take Q&A.
Great. Thanks so much, Jennifer. Very interesting. I was quite interested to hear the recent impacts of the pandemic on clean energy investment, given that I've been following it from perspective of city climate action plans. So we've got a number of great questions that people have submitted. So I'm going to stop sharing my screen here, and we can head to some Q&A. And some of these are aimed at you and me in particular, and some I think are more general. So we can just have a little back and forth here, Jennifer, on these issues. One question that came up was on the those levelized costs I showed for solar and wind. And several folks have asked, for example, what does the levelized cost of PV look like in places like New England compared to Arizona, where there's big differences in solar installation rates. And so that average cost that I showed you certainly glosses over that. And the cost is higher in New England than it would be in Arizona. But solar energy and wind energy are dispersed in such a way that some regions like New England that don't have as good a PV potential as Arizona have great offshore wind availability. So one of the good things about renewables is the ability to mix and match. And so I would also add that one of the biggest constraints to integrating renewables into the grid, and storage is a big issue. I mentioned the declining cost for batteries, but they're still expensive. But one of the real barriers, which isn't really a technical solution, is the actual structure of the grid itself. We need to, if there's a snowstorm in New England, we need to be able to wheel wind power in from Iowa. And we can't do that with the current structure of the grid. And a lot of that is, there's some technical issues, but a lot of it is regulation, and the Federal Energy Regulatory Commission, which has to approve those projects, which was designed and built for the coal era and the large central station power plants. And we need massive overhaul in our regulation of the transmission system to get power from one region to another. Jennifer, here's one for you. Someone asked if you could give some examples, specific examples of green bonds or green ETFs.
So unfortunately, it's my firm's policy not to name securities or strategies. So unfortunately, I'm not able to do that. But if you go, there's a lot of resources that are publicly available where you can find this different type of information. So one of them is the US SIF website. If you go to ussif.com, you should be able to find a list of funds there that are available for investment.
Fair enough. Another question, I knew this was going to come, it's a question on nuclear power. So in greenhouse gas terms, nuclear is clean in that very narrow sense of the word clean, in that it has very, very low life cycle greenhouse gas emissions. However, nuclear power has a lot of other issues, and a couple of folks have mentioned those. So in its favor, it has greenhouse gas emissions. It's by far the most reliable source of dispatchable power in terms of the percent time that the plants are up and running. Very, very reliable base load power. And there are no real constraints on the resource base, uranium and other resources that could be used to fuel reactors. However, there are other risks associated with nuclear power, and most notably 3 Mile Island, Chernobyl, Fukushima. So a lot of this boils down to how one views risk. So a routinely operating nuclear power plant is very safe compared to a coal plant, which just literally kills people left and right every day due to particulate matter. The life expectancy in Northeast China, where coal power is concentrated, has been reduced by 6 years due to emissions from coal plants. So how does one trade off day to day impacts versus the small chance of something very large going awry. And there are other issues associated with the safety of the nuclear fuel cycle and reprocessing and the weapons connection, and there are a very wide range of opinions. But at the end of the day, in the United States, I'll speak specifically to, it really comes down to that cost. And right now, there's no way that you can go to Wall Street and raise money to build a nuclear power plant because the alternatives are much, much cheaper. Jennifer, here's one directed at you, and somebody wanted to know whether you could offer an opinion on how real and how important it is for fossil fuel companies to reveal their risk of stranded assets in their public filings, and whether or not the market is being distorted by the lack of such information.
I think it's an interesting topic, the idea of stranded assets. I do think that it is important for fossil fuel companies to start disclosing that information, because that is a material risk to investors. And typically when you have material risk, they do require disclosure. I think it's interesting that certain investors have not, that hasn't stopped certain investors from investing. But if you look at trends in the energy markets over time, you've definitely seen a move starting to shift away from fossil fuel investing towards renewable investing overall. And I do think that part of that is because of the risk of stranded assets that investors are concerned about and that they want to avoid. And so obviously this past quarter was a bit of an aberration given what happened in the oil markets, but overall, if you look at trends in the energy markets, you are seeing a shift towards renewables. And I think part of that is because there is material risk related to stranded assets from fossil fuels.
Thanks. Here's an issue on storage that I think we both might have some insight into. And the question is a simple and good one. Is there any progress on the storage issue? So again, for those, most of you know that when you start to plug lots of renewables into the grid that are intermittent and hence non-dispatchable, how do you deal with the storage issue? And I think there is, so my take on this is the following. It's a significant issue. It's probably one of the largest technical issues that remain to be addressed, but there are lots of signs of improvement. The costs per megawatt hour of storage from grid scale batteries is dropping dramatically. We see that same precipitous cost decline for batteries that we saw for solar and wind. There's also a lot of interest in some parts of the country, including New England, where you have large amounts of offshore wind that at off-peak hours you could be used to support pumped hydro storage facilities that could act as a buffer as well. And in a more general sense, to the extent it's a technical issue, why would we, I go back to those technological forces that I described in that chart that I spent some time on. 20 years ago, if you told anyone in the energy industry, or 25 years ago, that we were going to be awash in natural gas and begin talking about exporting oil, you would have been locked up. And there's one thing that changed that, and that's hydraulic fracturing and horizontal drilling. And so if my point is this, if the right private and public folks open up their checkbooks and give the engineers and scientists enough money and resources, I think they can figure the storage issue out. That's one lesson from history that I've learned. Jennifer, any thoughts on in terms of your knowledge of renewable markets and what's happening with storage? How are investors looking at it?
Investors are really looking at it as a growth area, and it has been a focus within the markets, both on the public and the private side. I think you're seeing it more in private markets so far, but there are a number of companies that are looking to expand this market and solve the battery conundrum, because everybody recognizes the importance of having this technology and the importance it will have in terms of, fueling the renewable energy grid, but also the importance it has for developments like electric vehicles. So, I mean, we're seeing interest in it, definitely. It's, in terms of public markets, there's not that many ways that you can invest in that strategy right now, but I do foresee more of that coming in the future.
Great. Here's another question for you, Jennifer. A questioner asked, with this gap of over $500 billion per year in investments needed in the renewables and efficiency, public finance won't be enough, so you need to unlock private investment. And what do you see for the role of public and multilateral development finance, like the World Bank, work to energize and unlock private investments?
That's a great question. I think that there's a couple of roles that multilaterals will play when it comes to encouraging private investors to get into the space. I think the most important one that they can play is as a risk mitigator, because I think what keeps a lot of private investors on the sidelines is risk associated with, not so much with some of these technologies, but definitely with certain markets that they're maybe a little bit gun shy about getting into. And so if multilaterals can come in and provide first loss guarantees or other types of structures to reduce investor risk, I think it makes it more palatable for private investors to then come in and commit capital to these types of projects. I think also you're seeing greater cooperation between governments and private operators overall, not from a multilateral perspective necessarily, but for example, the Indian government working with different solar providers to get their solar needs met and to reach their construction goals that they have. I think you're seeing more of that, and that's encouraging.
Great, thank you. One of our participants reminded me about another storage option, Jennifer, that I neglected to mention, which is an interesting one, and so-called green hydrogen. So there are projects, pilot projects around the world, and I know of one in particular in Germany, where they're building wind farms that are dedicated solely to split water through electrolysis to produce hydrogen. So now you have a clean source of hydrogen that you could then use as a fuel. How you move it is a different issue, because the current natural gas distribution network is not really amenable to hydrogen up to once you hit about 10% mixture with traditional methane. But it's a very interesting option. Again, in New England, they're talking about using off-peak wind energy. So when the turbines are spinning at night, splitting hydrogen could be used in district energy systems. So there's another real interesting option to produce clean hydrogen. Another question, Jennifer, that someone asked that you may have some insight to, maybe a little bit out of your area. It's also a little bit out of mine, but that's never stopped me from offering an opinion, is the outlook for carbon capture to allow the further development of fossil fuels. So carbon capture and storage, where you essentially separate the carbon content of fuels from their heat content and enjoy the benefits of the energy, but not have the problems of the carbon, is of course very important. And most of the plausible scenarios that get us to 1.5 degrees around the world do require so-called negative emission technologies, not just carbon capture and storage, other options as well. So the challenge with carbon capture and storage is a technical one, but I think, again, that could probably be overcome with sufficient investment, but it's really one of time. You go back to that first graph, and there's no, to scale, demonstration of an economically viable carbon capture and storage system anywhere in the world yet. So we should be pursuing carbon capture and storage, but it's highly unlikely that it will come online soon enough to hit at least that 2030 target, but we should keep pushing. What are you seeing, Jennifer, in the investment in CCS?
So I think it's still early days yet for CCS. We've heard a lot of buzz about it, but I haven't actually seen a lot of dollars being committed behind carbon capture strategies, because you're still seeing very remunerative returns in other areas that are more established within renewable energy. So I do think that it's going to be a growth area, but at present we're not seeing a lot of funds directed in that direction.
Great. Let's see here, looking at some other questions that are coming in. And one a question that someone asked, Jennifer, of you, which is not something that you really talked about. I think they were looking at the ESG part of your job description. And the question is, to what extent does the focus on health caused by the pandemic and the focus on equity due to the violence against Black Americans that we've seen, how do you see that pushing the ESG market in any direction or another? Or is it too early to tell?
I think that overall ESG over the past, I would say 24 months has really seen a huge surge in the light that shined on it publicly, and the attention that it's gotten from investors, from the press, and just from the market overall. And I do think that these events, the pandemic and the social equity issues that we've seen as a result, have really reinforced our views of the importance of ESG when making investments, because you want to make sure that you don't have any of these risks in the investments that you're making, and you want to try to avoid exposure to these overall as well.
Mm-hmm. Great, thank you. Well, I see that our hour is nearly up. It's been great chatting with you, Jennifer. Learned a lot about investment. Before I turn things back over to Marianne, I'm going to briefly offer folks a way to stay involved and connected that we currently use here at BU, and I'm going to share my screen here briefly again. And I'm going to point you to, I'm now at on LinkedIn, and we have a group called BU Sustainability Alumni, which currently has about 1,100 members. And so these are faculty, staff, and students from across all 15 schools and colleges at the university who stay connected. And we use this as a way to connect students, especially with internships and jobs. Alums will send in jobs and we post them, in a way to connect current students, both graduate and undergraduate, from the humanities to engineering, with alumni. So if you're all interested, Marianne will include this information in a follow-up email, and we'll give you the details on how to join this. So Marianne, I'll turn things back to you, and again, thanks to everyone for joining, and great Q&As.
Outstanding. Thank you, Cutler and Jennifer, for being a part of our program today. Your information and insights were certainly very helpful for us on this topic. And as Cutler said, I will follow up with the attendees today with the information and links that you had addressed during your talk. I want to take a moment at the end here, not only to thank our speakers for being here, I would like to thank our alumni and friends for joining us today. And as always, a special thanks to our donors for supporting BU and programs like this. We have other programs that may be of interest to those of you in the audience today. In the coming weeks, we have one program, Beating Age Discrimination in the Career Marketplace, on June 24th. Social Cultural Impact of COVID-19 on the Latino and Latina Community, which is June 25th. Terrier Insights and Entrepreneurs Discovering Opportunities in Asia on June 30th. And on July 1st, we'll have a conversation with Dr. Ibram Kennedy, a founder of she's the founding director of the BU Center for Anti-Racist Research. Keep an eye on the BU alumni calendar for upcoming events, bu.edu/alumni/events, and check back often as programs are added on a regular basis. Thank you all again for joining us today, and we look forward to seeing you at a future BU event. Take care. Thank you. Bye-bye.